All right, thank you very much. Hope everyone had a good lunch, and let's try to do business as unusual for nuclear. I never thought I would say I would be excited to be in a full day of nuclear financing or financing of anything really, but it really all comes down to this. Just as David Victor said, all clean energy is essentially capital heavy and OpEx light. You need to gather a lot of money to build a thing that's going to make the energy, and it's quite cheap to run. And nuclear is the most extreme example. So nuclear depends on its average cost of capital more than anything else that we do. If the cost of capital is low, even if the plant doesn't look so cheap in terms of the capital cost, it's actually levelized quite a cheap thing to do. But if the cost of capital is high, it's the opposite, more than anything else that we do, essentially. And so I would like to kind of praise, in a sense, the people who are here from various financial institutions. It's easier, much easier just to stay home, look at who signed up, look at who dared to come and speak on the panels, wait around for a few weeks, maybe a month, and then say, oh, there's momentum building. Yeah, we're also in. And we're going to see that happen. We're going to see followers, I bet you many, many, many followers, and that's great. But we should really say that the people, the individuals that are here on panels and from these institutions deserve some credit because they took what shouldn't be a risk. It really should not be risky to put yourself behind clean energy, but it is in a way, and so they deserve some credit. So thank you all for being here, and thank you everyone who's supported the pledge as well. And let's get started. So Sarah, when we had this session in COP28 in Dubai, Canada was the star of the show. Canada had been innovating in innovation for nuclear finance, markets, bonds, certificates. Could you give us an update on what's happening in Canada and maybe a little bit about what your institution is doing in this space?
Yeah, sure. Thank you, Staffan. I'd be happy to, and thank you everyone for having us today. So, as mentioned, Sarah Thompson, I lead the Sustainable Finance Group for RBC Capital Markets. So my team in particular is very focused on working with both our corporate clients and also our institutional investor clients on all things environmental, social, and governance related. And so working with corporate clients, for example, to help them access capital in the sustainable debt market by way of bond issuance or loans that have certain ESG characteristics. And then likewise working with institutional investors who are integrating ESG factors into their investment analysis and process, find the product and the investment opportunities that they are looking for. So Staffan, to your point, Canada has been a leader in nuclear energy for decades now. And it's been really interesting to see the evolution of sort of the application, if you will, of the green bond structure in Canada in reflection of or in recognition of some of that innovation we've seen in the nuclear, sort of nuclear energy sector generally. So I'm from Toronto, Ontario. Ontario derives probably 55 or 60%, I don't know what the latest stats are, of its electricity from nuclear energy sources, another 25 or so from hydro, so a very clean grid. I think 18 of the 19 reactors in Canada are in Ontario. And Bruce Power, one of the operators of a nuclear generation facility in Canada, operates the largest facility in the world. So it is probably no surprise then that Bruce was the first globally, first corporate issuer of debt to issue a green labeled bond exclusively to fund the life extension of its nuclear facility. And this was the first, like I said, in the market. We had not seen prior to this green bond proceeds used for nuclear energy. And this was really a legacy thing. I think I would suggest that most stakeholders in the broader capital markets and the sustainable debt market in particular have long recognized the role of nuclear in helping us transition to a low carbon economy. But there were still many investors, I think, that had exclusions and couldn't invest in nuclear energy, or were struggling to identify how such investments could fit into their ESG mandates or funds. And so by being the world first here, by obtaining a well-regarded external review or second-party opinion of its bond issuance and program, Bruce was able to successfully execute a green bond transaction and raise capital for these life extension projects. And since then, that has really opened the door for others. We have very much a template now or a precedent that others can follow. So we saw Ontario Power Generation, the owner and operator of other generation facilities in Ontario, follow suit. We then saw the Government of Canada include in its Green Bond program the opportunity for allocation of funds to nuclear-related proceeds, and then we saw the province of Ontario do the same. So we've now got a very well-established sort of market that I think can be replicated in other jurisdictions. But I'll pause there and let others chime in.
And it's timely to bring in Gregory, who is kind of the architect of some of these innovative things that is happening with Bruce Power. I'd love to hear your story and what you have done, why you did it, and can we do it again? Can others do it? Can we be exporting the model that you innovated?
Sure, great, thank you. And again, thanks again for being here. So my role with a company called GHD, which most people haven't heard of, is we're a global professional services and engineering firm. And I help clients, usually corporate or private sector clients, with their journey to net zero or sustainability, and helping them really bridge the gap between their vision and what they can actually do and actualize. So, because at our core, we're an engineering firm. So we really look at that strategy aspect and then bring that to everyday life. So Bruce is a good example of that. We originally got involved with them about 4 or 5 years ago to help them write their net zero strategy. So we helped them do that and understand both their scope 1, 2, and 3 emissions. And in that process, they decided to start looking at carbon offsets as an option for the avoided emissions from the refurbishment of their reactors. So Sarah was talking about some of the things they're doing at Bruce, but they have eight reactors, and they're going through a process of refurbishing each of those reactors, to which will essentially produce a 9th reactor by the time they're all done that process. They were able to successfully, ultimately, register the avoided emissions on the CSA registry framework, and we helped them do that, essentially is what our role was. It was an interesting project. It had a lot of different challenges and risks in the sense that it had never been done before. It was new. We spent a lot of time researching and understanding what options were available and able to take those credits forward, or potential credits forward, and then worked with that, with Bruce very closely to ultimately get that approved and then register the credits. So is it something that can be replicated or not? I honestly don't know, is really the short answer of that. I think the challenge is that there are so many different registries. There's a lot of maybe chaos is probably the best word in the carbon credit market to begin with. There's a lot of people shy of carbon credits. They don't have the greatest name at the moment. So I think there's a number of factors there that do take it case by case, and it is a bit bespoke per opportunity. But the concept, and I think that's what's really important, and let's focus on what Bruce did from a concept perspective. They were bold and innovative in the sense that they moved forward, took a risk on this, and I think it's more important the momentum that they've started in the conversation they started like today around the opportunity to use carbon offsets in the nuclear area.
Thank you very much. We'll get back to some of that.
Sure.
But we had a discussion just before, which kind of echoes what you said now. So Oliver, who's an expert at this from Barclays, you were saying, change is needed maybe in the carbon credit markets. Could you introduce what you're doing and maybe those strong statements that you were giving to me earlier?
Absolutely. So yeah, my name's Ollie Morning. I'm the global head of carbon and environmental products trading at Barclays. It's interesting when you hear carbon markets, you hear words like momentum, that's positive, but also chaos. So I guess on one hand, I'm the head of chaos, but that's a challenging place with which to begin. But it's also a really interesting one. And increasingly, we see the growth of rules-based markets, be them clean fuels, be them carbon, as being the very common way that a number of jurisdictions are trying to drive their transition, price behavior, and incentivize change. The key thing about carbon and environmental markets is they're many and multiple. We're not talking a singular global market here. They're many and multiple. And that's important because when we look at voluntary carbon markets, which perhaps get a disproportionate amount of the airtime, they're very much going through a fundamental phase of change. Arguably, when we look at some of our clients that are trying to work out how they navigate it, they resemble something more akin to a consumer good. Even in clean energy markets, you can see that people often go for renewables over nuclear because potentially it tells a better story. That's challenging when essentially we're looking at how do you crowd in institutional capital to infrastructure-like investments. When something's a consumer good, it can go up and down with trends and tends not to always last very long. But when you're trying to crowd in infrastructure capital, that can be a real challenge. And so one area where we're very strongly focused with our clients is where do we see the growth of rules-based, typically jurisdictionally led markets that themselves can be catalytic in helping drive opportunities to crowd in capital to clean energy or clean carbon markets.
So a quick question before I forget, because I asked you and I wanted to wait here, and also for Gregory, if we need rules and we need standards and they need to be clear, who sets them and with what mandate and authority and how?
It's a really good question. So at the moment, you've got a sort of complex tapestry of different rules. Rules that are led by jurisdictions or nation states, but also rules that are conceived of by corporates. You could argue companies like Microsoft has set themselves a set of net zero rules. The reality is we're not here waiting for a singular global rule that enfranchises outcomes for all. What we're probably seeing is the globalization of climate or environmental policy. And what do I mean by that? Globally, there's strong acceptance that climate policy needs to happen, but increasingly it's quite local or regional in its implementation. And if you look at things like the CBAM, the Carbon Border Adjustment Mechanism in Europe, that's potentially a really interesting soft policy export where, of course, it has been controversial, but at the same time, you can see the growth of many regional counter markets in different parts of the globe that themselves are trying to see the fiscal importance of pricing transition in helping drive their own transitions in their economies.
Thank you very much. And I should mention that Barclays and Citi are both kind of signatories to what we're doing here today. And I should bring in Ashwani. I noticed on your title, which I don't remember all of it, but is Senior Vice President, something like that, of Power and Renewable, specifically renewables. So one thing I think the nuclear industry and everyone active in nuclear has kind of been jealous of always is all of these things that are labeled something renewable, including your job for the moment. There's been many, pledges, standards, requirements, subsidies, markets that have renewable tacked onto them. And so one thing I'd like to hear from you and from the experience of Citi as well as all of you is to what extent does that, exclusion, the renewable inclusion for them, but exclusion of nuclear, impact the chances of getting nuclear financed and getting, a lower risk profile for nuclear? And can we, is there actual momentum really behind the scenes to get this kind of level playing field where nuclear maybe isn't labeled renewable, but we just call it clean energy or something like that and do it all for everyone?
No, thanks, Staffan. This is Ashwani Khubani again. Just to simplify the title, I'm the corporate bank head of power and everything related to electrons. So it's easier to think through that way. I think you raise a very valid point. I think I would distinguish into two parts to it. One is existing nuclear, because that is really something which has suddenly got a fillip given what's AI and data sort of demand is coming from the Mega 7. And so existing nuclear, if you compare to new nuclear, there's a big difference, right? And I'll bring in point what is, I think we're sitting in New York, so we can talk about US. What IRA has done is it has given certain benefits to existing nuclear, and it has given certain benefits for prospectively for new nuclear, right? And all of that is, if you think about more broadly, it's helping existing nuclear to come online back, which has already started to come. Moreover, what it did is, it also, when the AI boom came to the market and when the demand increased, it actually gave those nuclear producers even more support, downside support, from what the price they can achieve with these AI players. So what we are seeing in Microsoft deal or Talon deal before that with AWS, we're seeing an increase in the economics to the nuclear power, right? And that is going to pave the way for new nuclear. And that's the way the direction of travel is, and it's a big improvement from what it was almost 18 months ago. Now, for those who don't understand, some of these companies were actually bankrupt not long ago. The AWS deal is done with Talon, which was a bankrupt company 24 months ago. So we're talking about something, it's a game changing, sort of effect. Once the Microsoft deal was announced, the supplier, which is Constellation, has seen a significant increase in equity value overnight. They're like 25% up in no time. So I think it's fair to say that nuclear has never received the kind of subsidies and support it has in past, but now the attention it's getting, because it is a base load, not an intermittent supply, but a firm supply, and the value of that carbon-free supply is, just as we speak, invaluable.
So yeah,
Oh,
please.
well, if you have a follow-up question, Staffan, go.
I'll
Okay.
go after you. I don't
Okay.
want to.
Well, I just want to say, I think going back to some of the comments I made earlier about the green bond issuance that we've seen in Canada, I think it does underscore this very marked shift we've seen in perceptions of stakeholders in the capital markets towards nuclear. And I mentioned that historically, sustainability-focused investors didn't just not invest in nuclear, they had explicit exclusions against doing so. And they were very concerned with the presumed social or health and safety and environmental related risks from waste management and so on. And I think that part of this shift is a growing pragmatism and a growing realization that we do need all forms of low carbon energy to make this economic transition that we've all committed to doing, and that nuclear will play a really key role in that process, not just the extension of the lives of existing nuclear facilities, but equally new nuclear technologies. And in Canada, I think there's a very significant focus on small modular reactors for industrial applications, for rural and remote communities not on the grid who rely on forms of energy like diesel generation, which is problematic for many reasons. So I just wanted to underscore that point about this marked shift towards the inclusion of nuclear in this broader sort of universe of low carbon energy generation. And maybe the last thing I'll say, and we can come back to this, is just this would reflect how RBC is thinking about it too. So we've made a commitment back in 2021, 2019 originally, to provide $500 billion in sustainable financing by 2025. We didn't originally include financing for nuclear energy-related uses in that original definition. We have since included in our definition those types of activities. So we're not alone, I know that for sure. We've made a commitment to triple renewable energy lending by 2030, but equally to grow low-carbon energy lending, which includes renewables, but also nuclear and transmission and distribution, and so on. So I think that's a very important piece.
Yeah, I think it's an excellent point also that we really bang the drum when we do something like this, because if you're at New York Climate Week now and you get invited to an event, one of your first questions is, who else is coming? Who else is going? And if you're going to sign on to something or stand behind something, the first question, even if it's very well motivated, and scientifically built the case for it, it's always going to be like, who else is in, And so the value of this kind of event is also say, we are doing it. And then you can point, oh, they're doing it, they're doing it. Okay, yeah, we should probably do it.
On that point, not to hog the mic here, but just while we're on it, I think this is what we've seen from our issuers in Canada. So Bruce being the first to issue green bonds for existing nuclear energy generation facilities. And that was a huge milestone in the development of the sustainable bond market. Nobody could have envisioned that before. Then we saw others follow. Then we saw Bruce come back in 2023, I believe, and include new projects as well, new nuclear projects. And then we've since seen OPG, or Ontario Power Generation, do the same and include not just refurbishment or extension of existing facilities, but R&D for new technologies and new SMR technologies and so on, all included in their green bond program. And this has been very well received by, certainly by Canadian institutional investors, but I think what we've seen in other jurisdictions who have taken that template and applied it, equally well received by investors in other jurisdictions.
Yes, Staffan, I would just add to your other point, like who's in there. So I think once AWS did their first deal with Talon on nuclear, I think everybody in the Mega 7 looked at it and said, we want to be there. And the reason behind that is, even though a lot of Mega 7 are focused on renewables and additionality of renewables, it's intermittent, right? So at the end of the day, it doesn't give you what you need. And even some of the existing deals which have happened, they are under scrutiny right now because that takes away firm power from the grid. So if you see, improvisation of that in Microsoft deal is that they actually found a plant which was closed, is not supplying to the grid, is now actually coming back online for Microsoft, right? So I think it's getting more innovative because there's economics behind it, right? And I think the question really is, I don't think there is a subsidy conversation around nuclear. It's a more cost and how you get the financing long term around it is the question which we need to answer. Because I don't think there is a challenge around what you can derive from nuclear. It's not the same as renewables.
So I want to drill down a bit on the comment you made. We have to keep two conversations separate. It's the existing nuclear running longer or coming back that's been online, and the new nuclear. So if you're a utility, a big energy company, obviously a quick way to get a 27% bump in your stock price is to bring back one of your recently shuttered nuclear plants. That's a good tip. But would the same thing work for building new nuclear? So let's say you didn't have a plant that was just shut, or didn't have a plant that needed to be refurbished, but you want to build an entirely new data center, what it might be, and a nuclear plant to supply it. If you would imagine that you have the players involved in that deal, but it was a new build, it's a different risk profile, would that be bankable? Would that be financeable in the same way, or is there something missing in the, I think they would call it magic sauce or whatever? How does that differ?
I'll give my views and I'll let others also share, but I think the challenge has been, and I think it's been very well overcome by the Abu Dhabi, nuclear program, is how to think about the cost and the time, right? And I think unless you define that, it's hard to get your head around it. You can get a lot more value if you have a strong view on how you get around it, right? What we are seeing, I think, and I would, I would let others add, but I think what we are seeing is the EPC contractors, the technology providers, are willing to now think about all-in cost, right? And I think it's not easy to think through still because the labor cost and the development cost in different parts of the world and the regulations are different. So you can't really just get your head around it so quickly. But I think there's a recognition that without that, the contracts are not going to come and the development is not going to happen, right? So I think there is definitely some more brainstorming around how to risk allocate, right? How to really manage the cost. And I think on top of that, what governments are doing and what we're seeing in the case of Sizewell C in UK is how to think about a regulated asset base if you really want to do something like that in a more meaningful way given where the governments are, right? So I do think there is innovation happening in that. I do think people are coming together to bring ideas together, but it doesn't mean that it's there yet, and I think we'll see more progress in coming months.
Can I just build on that? Agree, and I would take it a step further and say, but the conversations are happening, and I think that's the really important part. And it's the fact that we're even talking about financing new nuclear isn't something that was being talked about 10 years ago the way it is today. So I think it is really, we're on a journey. We're not there yet. Things are happening, and we're getting that momentum we talked about earlier. So it is all of these things together that are fundamentally shifting the conversation, which is opening the door to these newer conversations around nuclear as clean energy and driving that forward. So while I agree with you, we're not there today, and there's still some challenges, there's optimism that we're going to start to continue to move forward and find those solutions as we look at this, because it's so critical to the future from a clean energy perspective.
I think I'd add to that. What we see when we're looking around opportunities in that space is a series of necessary but not sufficient conditions. So it is necessary for someone to want to build that new reactor, but it's insufficient without probably someone on the other side off-taking the long-term power for that. But their off-take itself is probably insufficient without policy and regulation that gives them the longevity of certainty. And so perhaps one of the interesting things to come from the ESG backlash is this move towards pragmatic policy from perhaps more a purity of policy. And in a pragmatic policy where you're recognizing the physical reality of transitioning a system, which is complicated and largely molecular versus megawatt, there is the opportunity to try and crowd in capital to make those necessary and sufficient conditions work together. And I think that's a really interesting space. And when I look at what the likes of Microsoft or other large corporates are starting to do, earlier I mentioned the challenge of consumer goods. And I think that's still a fair observation of much of the voluntary carbon market. But perhaps when you look back in a few years' time at what Microsoft is trying to do, where you look at its different range of carbon removals or clean power offtakes, it actually starts to resemble and akin to its own utility market. There's a set of dependable rules, there's clear longevity through time of those rules, and actually all the different parts that it's building resemble something akin to a merit order stack. And I think that's really interesting to observe, and the challenge will be then, how do you crowd in other similar like-minded corporates? Because then the policy itself will probably go hand in hand.
So there are a number of new build suggestions. There's projects budding. We heard from TerraPower earlier, for example. Are they coming to you or the likes of you to say, how do we get carbon credits for this? How are we going to get into the carbon markets and get additional revenue from this? Or is that kind of nascent?
It's definitely well beyond nascent. I think you can see just from the sheer sort of media attention, there's a high degree of focus on this area, but also a high degree of intent on wanting to build operability. I think the way that we look at it is, rather than strive for one model that fits all, in reality, you're better off finding small pockets of operability, try and replicate, try and link them together, because typically that's how markets tend to grow through time. My background's in commodities trading on the gas side, and I'm always loath to draw too many analogs to other commodities markets when it comes to carbon. But I do think it's interesting that when you look at the growth of global gas, in reality, it's about the flows of capital between a series of regional markets. And I think those models of how you drive operability are quite analogous to what we see in the energy transition, where there isn't going to be one model that fits all. The reality is countries are going to pursue different NDCs and different timelines by different means. And so having that more patchwork effect where you can focus on operability, but it's probably still quite regional and local, is probably the pathway where in aggregate you achieve a bigger outcome.
So when we're talking about innovation, I know it's trying to drum up interest for this with my panel, but I want to talk about it because most of this discussion, almost all of it, is relating to the sale of electrons, electricity. So you build power plants, you sell electricity, and your bankability is on, part of it at least, is on how reliable the purchasing of that electricity will be for the decades after you build a plant and all this. But if you look at any pitch deck, any presentation from at least advanced nuclear and small modular nuclear today, part of their business case, or a large part of the business case, is cogeneration. They are hoping to sell both heat and power. And the heat component can be quite large. But it seems to be, so far, somewhat missing from like the financing discussion. How bankable, I guess, is my question, is the heat component of a new nuclear build? I don't know if anyone wants to suffer for trying to answer that. And it's also it's an indication that we haven't thought about enough, maybe, that we're not.
I think it's fair to say it's an indication of where this stands right now, because it is part of the pitch, but you're right to say that. I think we are still dealing with the threshold issues of where to get to SMR first for electricity before it gets to heating. So fair criticism, but I think it's
Not criticism, just observation, I guess.
Yeah,
I'm happy to add. At lunch, I was speaking to someone from the audience who I think oversees the energy consumption of this building, and we were talking about the steam that it consumes, so heat. And it's fascinating because we were quickly on to the fact that 80% of that has to come within the New York boundary. And we were pointing out to the stack where it is getting produced just by the river there. And I think that's part of the challenge, is that in reality, to transition the existing system, rather than seek the nirvana end like new state, you're better off leaning into the existing system and think, how do you incrementally modify that through time? And so in reality, I'm not an expert on heat networks, but there's a whole set of existing infrastructure there that probably has to tie in to policy objectives and how you pragmatically deliver an outcome rather than get to the end goal in one sort of step change.
So is your, like I say, you can have individual opinions, obviously, but does it seem like we're kind of trialing what will work for new build in these projects where we refurbish or lifetime extensions? We're trying it there, and then we're going to apply it to new build. Is that kind of the thinking? Not about heat, but in general, about
I think
carbon
it's
markets
happening in
and
parallel,
credits.
in my view. I think it's happening in parallel. I do think the economic support is coming from the existing assets, right? Because that gives you the visibility on what you're supposed to see at the end of your construction cycle, right? So I think, and it also gives the off-takers some visibility on what they're going to get upfront versus longer term, right? So I think there is just more excitement around it starts with what is there already and what can be recommissioned in a quick manner. And quick is also like 2-3 years here, right? So we're talking about still a gestation period here, not compared to renewables. And so still some ways to go, but 3 years is more digestible than 13 years. And so I think it definitely starts there.
Yeah, and I think the economics clearly make sense for existing nuclear and refurbishment and driving that forward. You're seeing Ontario has OPG is doing the same thing as well now, right? So whereas new nuclear, the economics aren't quite there still. I think we're getting closer, and I think it's all of these little things that are starting to add up, and as we continue to drive them forward, we get to those tipping points where then big things start to happen. And it's really important that we keep focused on the little things, and sometimes, it's not about making a bunch of big moves. In my mind, it's about making a bunch of little moves, and as those middle moves start to add up, they create that tipping point, and then things start to really accelerate, and that's when we'll continue to, we'll see the bigger plays and the bigger options happen, but we need to keep driving forward, and that's, going back to the Bruce story, that's why they're so important in this conversation, right? Taking a risk, going out, doing things, whether it's green bonds, carbon offsets, really starting the conversation, being there on the global stage to drive the new nuclear conversation and refurbishment conversation of existing helps to create that momentum, and it is about the momentum to really get back to the theme of this, is that's really what we need to keep driving in the nuclear sector.
And just building on that, I would add that I think it really is all about signaling and awareness building in the sustainable bond or sustainable debt market currently, because there are certain expectations with the issuance of green bonds that proceeds raised will be allocated in the very near term, if not at the time of issuance. And so it makes it very difficult to issue a green bond, for example, today, that will fund new SMR technology that doesn't yet exist. And so I would argue that the reason or the rationale for Bruce Power first and then OPG secondly, including new nuclear projects in their green bond frameworks, was for signaling and awareness raising purposes. And what we find over and over again is that green bonds provide a really powerful communication tool or platform for issuers to speak directly to their institutional investors. And so this has created opportunities for engagement with existing investors, with new investors, with I guess different portfolio managers from those existing investors all around. What does this mean? What does this look like? And I think then you create that awareness and familiarity, which helps get us further along that journey.
Same approach with offsets they're taking. Yeah.
Would you need to make new types of products and then bundle near-term nuclear refurbishment and longer-term nuclear new build in one product, and say one bond of issuing that you can start spending from immediately, but also has a longer-term component? Would that be?
Well, maybe that would be partly the R&D inclusion from OPG. So they sort of defined how they could allocate proceeds raised through their green bond issuances for research and development related purposes. But I think, it's not to say it can't be done, but one of the reasons why typically investors want to see those proceeds allocated right away is that they're buying that bond for a green fund. They need to know that it's actually green. They need to be able to look through or see through to the underlying assets to ensure that they do indeed qualify as green, for example, for their particular funds.
One thing I'd add on that, and if I could draw an analog from carbon markets, is obviously carbon markets have had quite a volatile sort of growth trajectory and story. But one of the things that perhaps have been one of their challenges more recently is this notion of carbon catharsis, i.e. every time there's an issue or a challenge, better to reinvent yourself as something slightly different rather than build upon the learnings from that. And I think one of the key things this whole area is how do you create a safe space to fail? Sounds an odd thing to say at a nuclear energy conference, but stick with me. It's more a safe policy space and investment space, because in reality, this is about breaking new ground, it's about driving innovation. Very rarely do you get it right first time. And so there'll be some things where perhaps the bond didn't end up looking as green as the original specification because best practice policy changes through time. How do you create an environment where it's safe to come in as catalytic capital, as institutional capital, without then having that risk of catharsis 2 to 3 years later.
And so maybe just to build on that, it's a really interesting point you raised, because I think as we've seen the market evolve, as we've seen both issuers and investors become more sophisticated, as we've seen a backlash against ESG, we start to see the usefulness of these labels perhaps fall away to some extent. Really what was so impactful with the concept of a green bond was really the transparency and the disclosure that that type of structure required, and therefore gave to investors around how proceeds would be allocated versus for general corporate sort of purposes. And so I would argue that best practice for any issuer is, to the extent possible, provide that type of transparency and disclosure to investors, whether or not there is a label on your bond, because that is, again, a way to connect some of these dots, I think, and to increase sort of familiarity and comfort levels with these opportunities.
So if we look at other kind of risky, capital-heavy, first-of-a-kind risky developments, we have, from my own experience at least, carbon removal, so removing carbon from the air. A lot of the technology is brand new, and so they're facing kind of the same issue. You have to spend hundreds of millions of dollars to build a big plant. You don't know if it's going to work. You don't know how long it's going to take to build, so maybe even more risk than many of the nuclear development, even new nuclear development. And then you need to finance that somehow. And what I've seen there is, people like Frontier, so these kind of clubs that come together and say, if you get something up, we'll buy it. We're for sure there to buy it at this cost. There's a quite premium to be catalytic. In geothermal energy, this is very similar to nuclear. Advanced new geothermal, companies like Google are saying essentially the same thing. We'll be there. We'll be there at that location to buy it at this price. If you manage to build it, we're there. And then these companies take these documents to the bank, literally to the bank, to get project financing, and they sometimes succeed. So I wonder if that's, is that a model to follow, or is it just too difficult for nuclear to do something like that?
I think, the fundamental of of credit underwriting, right, is sort of boils down to what is the downside risk, right, and how do you really cover the downside risk? And I think the answer lies in the sponsor and who's involved in doing that, right? It's normally you can take a view on an existing nuclear player doing a new development, and however risky it may be. Take an example. Southern Company did Vogtle and paid so much money over it, but nobody was concerned about Southern Company, right? Now you can take a new developer and talk about it. I think the answer would be different, right? So I think it's fair to say that these are the challenges, and how do you really sort of play through the downside? And I think it's easier to think through when there are more credible sort of sponsors involved. It is easier to think through that, and I think the answer actually, even in normal scenarios, varies based on the sponsors. So I think it really boils down to which sponsors are willing to step up and take that, take that risk allocation up front, because they will eventually benefit from an equity standpoint. But do you really get financing without it? And I think what we're seeing in new technology development, there's definitely equity placement happening, and more people coming and taking a view on that. And that's where I think we're seeing more sort of financing upfront for the first of the kinds, happening in more an equity fashion versus a financing through the credit markets or capital markets.
And I'm assuming there's a role for government to step in and guarantee those loans, underwrite your underwriting, essentially. Would that be the final catalytic push to make this happen?
I mean, I think...
Sorry, go for it.
No, go for it, please.
Or it becomes a risk, because the interesting thing here is it looks quite analogous to the long-term gas contracts that were put in place in Europe all through the 80s, 90s, and early 2000s, is you're putting together multi-decadal contracts of certainty against a backdrop of near certain change, be that policy change, be it geopolitical challenge. That's a highly complicated offtake contract to then make bankable. So absolutely governments can play a role there, because I mentioned that sort of perfect triangle of corporate, government, and producer. But how do they ensure that they give the certainty that that contract can navigate change without inadvertently injecting more change that then potentially breaches the contract in itself?
I'm looking at you, Sarah. How important has the Canadian local and federal government been?
So I think that Bruce Power and OPG, with their large, existing sort of operations and their debt programs, haven't necessarily needed government intervention per se, but the Canada Infrastructure Bank has been very active in this space, and I think is a key player to help de-risk some of these opportunities and backstop private capital. So absolutely, I think it's key. And then I think the broader sort of policy tone, if you will, in the Canadian context, where the federal government has been very vocal about the role of nuclear in meeting Canada's climate commitments, and particularly the future role of SMR technology and so on. I think that is helpful.
Well, I would like to thank all of you extremely much for being here, for being on the panel, for being in the discussion. I think if we do this, when we do this a few months from now again, there's going to be 3-4 times more, and they're all going to be kicking themselves that they weren't brave enough to step up now. These discussions are, mature, but also just beginning, I think. And so thank you very much, and thank you all for listening, and thank you, panelists.